the cornerstone of risk management. In this risk management tutorial, we focus on controlling risks using various tools and strategies. The cornerstone of risk management is the point of entry into a stock trade. Effective risk management is largely determined at the moment of purchase. If executed correctly, many problems are avoided from the start. Essential to this is the concept of low risk entry points, meaning buying stock when its price movement is confined to a tight range. This allows for easy identification of normal versus abnormal stock behavior without having to endure substantial losses. Identifying what constitutes normal behavior in stock movement is crucial. Abnormal behavior should not require tolerating significant losses to be discerned. Recognizing and reacting quickly to stocks that are not performing as expected while incurring minimal losses is a valuable skill. The focus here is particularly on identifying volatility contraction patterns, VCP, and understanding the behavior of stocks under accumulation. However, it's also critical to recognize that even successful patterns like VCP can eventually fail. This failure typically occurs when short-term supply, previously absorbed, turns into longer-term demand selling off, leading to a breakdown of the base and failure of the pivot. Understanding these dynamics is key to not paying too much for this critical information. This tutorial is separated into 5 different parts, all of which will help you understand what are the best practices for risk management, a vital skill for the long-term successful trader. In Section 1, we will look at low-risk entry points, and we will go over 2 theoretical examples. In Section 2, we will focus on the relationship of position sizing and stop losses as a tool for managing risk. Section 3 will explain the idea of progressive exposure and how it could amplify your results. From then on, we will look at Section 4 and how to develop a trading system with built-in room for failure. Lastly, we will talk of a few tools we can use to reduce drawdowns. Let's dive in. The concept of a low-risk entry point is fundamental in risk management. It involves buying stocks at a point in their price movement where the risk of a significant move against the position is minimized. This strategy is about finding the right moment when a stock's price behavior is tight and predictable, allowing for a quick and clear identification if the stock starts to act abnormally. In essence, it's about understanding and identifying the normal trading range of a stock and being able to spot when it deviates from this range. The tighter the area of purchase, the less movement required to signal a deviation from the norm, thus reducing the potential loss. This method is especially relevant when dealing with VCP, where you're looking for that constricted price action as an indicator of a good entry point. However, it's vital to remain vigilant as these tight areas can fail. This failure typically happens when what was perceived as short-term supply drying up actually turns into longer-term demand starting to sell, resulting in a base breakdown and pivot failure. Recognizing these patterns and their potential pitfalls is crucial in minimizing risk and avoiding costly mistakes. As you can see in the example on the slide, Trader A buys from a tight consolidated pattern and can use a very small stop loss that, if violated, would signal an increased probability of setup failure, as it would be abnormal for a rocketing stock to move under this level. By contrast, Trader B buys a volatile stock. In order for Trader B to conclude an abnormal behavior in a stock, he has to have much wider stop. As you see, every if both buy and sell at the same point, Trader A can result with a 4R win compared to Trader B. If you are unaware of what an R multiple is, in the context of result reporting, make sure to visit my blog, found in the link under my profile in TradingView. A second example of low-risk entry point is the idea of buying right and avoiding slippage. If you look at the example, an ideal buy point at $30 in a fast-moving stock would have both Trader A and Trader B chase the stock. Trader A buys 1% above the perfect buy point, while Trader B is a bit slower and chases, resulting in his buy being 2% above the perfect buy point. Now, if they sell exactly at the same point, we can conclude that over 200 trades, which is a low number of swing trades in a given year. For a breakout trader, Trader A would have performed over 67% more than Trader B. And this is if there is 1% slippage on the buy side. So we can conclude that buying right from low risk entry points is an important rule for managing risk. Position sizing and stop loss are crucially interconnected in managing risk effectively. They work together in a way where you tailor your risk based on a percentage of your total equity, which ideally should be around 1.25%. However, for those more experienced and in favorable market conditions, this risk can be cautiously increased up to 2.5% of total equity. Calculating your risk is relatively straightforward. The risk of total equity determined as a percentage divided by the position size gives you the stop loss percentage. For example, with a 1.25% risk on total equity and a 12.5% position size, the stop loss would be 10%. If you opt to increase your position size, say to 25%, maintaining the 1.25% risk would necessitate having your stop loss to 5%. This balance is vital to manage risk effectively. Moreover, aggressive trading strategies, such as taking a 50% position size, call for even tighter stop losses, like 2.5%, to keep the risk of total equity at 1.25%. It is essential to understand that it's not just the position size that defines your risk, but the interplay between position size and the percentage of risk relative to total equity. In different scenarios, like considering taking larger risks, you can opt for a 5% stop, which would increase your risk of total equity to 2.5%. It's a matter of fine-tuning these parameters to fit your trading style and risk tolerance. Keeping within these guidelines drastically reduces your risk of ruin, especially if you adopt an incremental approach and finance your risks with profits. Additionally, it's important to adapt your strategy based on market conditions and your trading performance. Start with lower risks and progressively increase as you gain more experience and confidence in your trades. This approach ensures that you are not overexposing yourself in the market, especially in volatile conditions, and it leads us exactly to point 3 of progressive exposure. Progressive exposure, also known as incremental trading, is a strategy where trading exposure is gradually increased, rather than jumping from zero to full investment immediately. Typically, this involves making initial investments in increments of 25 to 50%. For instance, in a bear market or correction, you might initially invest 25% of your portfolio across several smaller positions. If these positions perform well, you can consider increasing your investment to 50%, possibly with fewer but larger positions. If the positive trend continues, you can become more aggressive, moving to 75% and eventually 100% investment, focusing on the best performing stocks. This method, often referred to as pyramiding, ensures that you are trading your largest when performing best. Conversely, if your initial investments do not perform well, you should not increase your exposure, but rather reduce it or even revert to cash. This strategy of adjusting exposure based on performance ensures that you trade larger amounts during favorable conditions and smaller amounts during downturns, which is opposite of what many traders tend to do. By not having fixed rules and respecting the market's behavior, traders often end up making mistakes, leading to significant losses. Progressive exposure, when done correctly, ensures that you're incrementally investing in the right direction based on the market's response to your investments. Generally, I look at my last 5 trades and assess how they performed. Were they mostly winners or losers? Did the winner reach close to my average win rate or not? These are some clues for me to understand whether it is a good environment to increase exposure or not. Risk management in trading encompasses 3 primary pillars: stop loss, position sizing, and progressive exposure. These elements need to work together synergistically. It's not just about setting stop losses to limit bigger losses. It also involves making informed buying decisions and adjusting your strategy as per market performance. Position sizing plays a critical role in mitigating overnight risks. For instance, if you have a significant portion of your portfolio in a single stock, any drastic overnight price drop can lead to substantial losses. A balanced approach would be diversifying across multiple stocks, thus reducing the impact of any single stock's performance on your entire portfolio. A maximum of around 25% per position is suggested for managing this risk. Progressive exposure complements these strategies by ensuring that your investment increases are gradual and based on successful trading performance, reducing the likelihood of significant losses during unfavorable market conditions. If you only nail perfect stop loss setting and have good progressive exposure, but you do not have correct position sizing, you will have very small positive impact in your account. Conversely, if you have great stop loss rules and correct position sizing, let's say 25%, but you do not pyramid in and out depending on market conditions, then you will have very high equity volatility. Therefore, in order to have perfect risk management rules, it is important to use these three levers in your trading. Maintaining a positive risk-reward relationship is crucial for successful trading. This relationship dictates that your average stop loss should be a function of your expected average gain. The reason for this is because out of the three components of the trading profit formula, win rate, reward, and risk, risk is the only element that you have direct control over since it is a function of when you buy and when you sell. You cannot control how many times this will happen, nor can you control if the stock is going to go up and buy how much. Therefore, if your average gain is around 10%, then aiming for a 2.1 reward to risk ratio would mean your average stop loss should be about 5%. However, this ratio needs to be flexible and adjusted based on actual trading outcomes. It's important not to overly rely on your win rate, but rather focus on keeping a favorable reward to risk ratio. This approach allows for a margin of error in your trading, where even if a significant portion of your trades are not successful, you can still avoid incurring losses. Operating with this mindset reduces the pressure to have a high success rate in your trades and emphasizes the importance of managing losses. As the upside often takes care of itself, while the downside doesn't, I generally want to trade a 2-to-1 system or better. Lastly, after learning to use tight stops, progressive exposure, and position sizing, it is good to control risk using several other strategies. First, selling into strength to prevent significant drawdowns, and trading directionally with the market trend. Selling into strength is an interesting concept. Yes, it is very likely that you will not pick the top. But this is not the point. The goal is to reduce volatility in your equity curve. This can only happen when you sell into strength. In that case, you will sell when the equity curve is at its highs. The stock can easily continue to go up, but this does not affect your equity curve. A second subsection to this rule is to sell half. Selling half is psychologically a win-win position. If the stock plummets, you will be happy you booked some gains. If the stock soars, then you will be happy to have half position. Of course, when you sell half will hurt your average gain, but at the same time, you protect your downside and allow yourself to get a free roll, which is a great position to be in. You can be protecting your break-even point or use short-term profits to finance your stop losses. For example, if a stock climbs 15% and you sell half, you can now let the remaining half drop 19.5% from the new price, and still you will be break-even. This approach of combining tight stop losses with progressive exposure and smart selling strategies significantly improves your downside protection. It's also crucial to never average down on losing positions. Limiting your losses to no more than 1.25% of total equity or up to 2.5% in a strong market is a key aspect of this strategy. By using these methods in tandem and constantly adjusting based on your gains, losses, and market conditions, you position yourself to handle both the downside risks and the upside opportunities effectively. Hope watching this video you have learned something new that will benefit your trading style. Thank you. Yours truly, Tin Tin Trading.